All right, let's get this thing started. Full screen webcam, and we are back. There we go. We finally are making it 2 consecutive weeks. I almost got all the way through my peanut butter crackers. I'm going to have this last one staring at me for the duration of the stream. But welcome back to another weekly live stream. Again, appreciate all you guys who tune in on a weekly basis, joining us at 9 o'clock Eastern. And those of you who watch after, we love you all equally as well. But if we get up to 30 live viewers tonight, we're going to give away an HT tumbler. Normally it's right here to my left, but I think I put it away because I was cleaning up my room. But rest assured, if we hit that number, one of those is going out to you guys who is watching live tonight. But without further ado, we've had a couple good weeks. Let's jump into it and let's start talking about it. Don't have a mouse today, which is super annoying. So I'm using the trackpad on my laptop. So apologies if the dexterity on the mouse side of things is not working out too well. But we'll get through it together, and I will try not to leave it at the office next time. But here we go. Long story short, net profit last week was $1,003. And at the end of the day, our big goal in 2023, what do we say every single week? Our big goal is to keep taking steps forward, and we have accomplished that. Now, it comes at the expense of underperformance, but let's take a step back. Let's think about things. Why did we underperform? How did we generate our profit? And the answer is we kind of underperformed, one, because we had a very, very low percentage of our account in play. And having a low percentage of our account in play is going to give us a lot of flexibility and really, really help us when the market does decide to turn around. We remember that back in February and March, we did see a little bit of a dip in the market. And a lot of the questions we get, and we talk about this every week, how does the strategy perform when the market turns south? And we saw NASDAQ and the S&P 500 sell off pretty decently. We continued our winning streak. Now, NASDAQ's running away a little bit, and the S&P 500, we're still actually outperforming right now, even though it's having a great year. But we're also having a really nice year. And what's really important to note about this is, one, we don't have a lot of our money in position, so our risk, a level of risk we're taking on these returns is very, very low right now. And two, we're doing this with both bullish and bearish trades. And what that means is we're not dependent on the red and the yellow lines for the S&P 500 and NASDAQ respectively. We're not dependent on those to go up for us to make money as well. And again, this is all going to come together. I'm sure there's going to be a week we're talking when the market finally does take a turn back south and we say, hey, look, this is why we did it. Ta-da. And then we have a couple of weeks of evidence of that earlier in the year, but we got to run our own race. We note that the average return in the S&P 500 is between 9 and 10% per year. And we are already above 10% right now, and we are not even at the halfway point in 2023 yet. So as long as we focus on running our own race and we keep this up and we finish with like a 25% return on the year, I think that's a fantastic, fantastic result. So let's talk about what we did last week. And then with that additional context, because I think it's very important to establish that, establish what our goal is, why we're doing what we're doing, and why we got the results that we got. Underperformance isn't necessarily a failure when this number here is green, because we're confident, like if we go 2 weeks ago, that when the S&P 500 is red, we're still green. And 3 weeks ago when the S&P 500 was red, we're also still green, right? Bigger picture, if we look at what we've done so far this year over the last couple of months, it's not letting me scroll over, but we basically just not wrapped up, hopefully we keep it going, but when the bell rang Friday, it meant that we had 10 consecutive winning weeks, which is one of our longer streaks ever. And over that time period, we have made $9,880. And while some of these weeks may have been a little bit more muted from a profit perspective, right? We saw 174, 142, 358. The big thing is that on average, we made $988 every single week. So as long as we keep pushing forward like that, we're going to see some really nice results. Exclusion of the red week really helps that progress, right? And what I like to do sometimes, maybe kind of regrettably so, is like we have this one big week where we lost $3,700 due to an XSP strangle. We had a little poor luck in some of our positions. However, to see how effective, or I guess how detrimental a red week like this is, if you just not even zero this out but make it minus 500, watch our profit curve right here. We go from dipping down and being at like 11% to continuing forward, being pushing 15, and really significantly outperforming the S&P 500. And you might say, HT, like obviously if you take out your worst week, your year's going to look better. I agree with you there. But the point being is that we're trying to take the foot off the gas to avoid another dip like this, so that we can continue this and we don't have to dig ourselves a hole that we need to come back out of. So that's kind of the pep talk at the beginning of the week. And now even though I've said let's get into last week, let's actually finally talk about last week. One thing off the bat is our returns were padded a little bit by this SWVXX interest. What is SWVXX, you may ask, for those of you who are unfamiliar? It's a money market fund. And with all of the news with what the Fed is doing, raising interest rates, you see a lot of high yield savings account offering 3-4% to have your money parked in there. That's applicable. All of those rises in interest rates are applicable to what we do in our strategy. Because we think about this, we're not buying stock, right? We might have $100,000 in our account. We're not spending $100,000 to open our positions. In fact, it's quite the opposite, right? When we sell an option, someone gives us money. So our actual cash on hand, quote unquote, is normally larger than our account balance itself. So the question we want to ask ourselves is, hey, how do we benefit from having this huge stack of cash in a high interest rate environment while we're doing this on the side? And the answer that we've come up with is buying a bunch of these money market shares, SWVXX. Now, every broker is going to be a little bit different in terms of what they offer, but I would encourage you to potentially have a Google search. There's also T-bill ETFs that you could look into, but the idea is if we need this money tomorrow, we can get it. We just sell out of the fund, it comes back into our account. We're not going to be able to get this intraday, but we're not going to need all of that money intraday with what we do. So we sit it in there, and once a month we're going to get $400 from it. And I think what I'm going to do is purchase even more. I haven't really checked the margin levels yet, but apparently once you hold SWVXX for 1 month or 30 days, I think is the correct technical number, it becomes marginable, right? So when we bought this, it took $120,000 and it took $120,000 of our buying power. Now that's not a big issue because we're always around like this 25 to 30-ish level range. Isn't marginable in TDA though. Something like USFR is 75% marginable at least. That's a good point from Jeff. That's something that I'm looking into because we literally just hit the 30-day mark last Friday. And if it turns out that this isn't marginable and we don't get all of our buying power back, I'm definitely going to look into something like USFR, which I believe is one of those T-bill ETFs, which we alluded to. But either way, that's the idea. We want something in a very, very safe asset that's paying a fixed return. And then we want to use margin against that. You know, we don't want to use margin to open our positions and sell more cash secured puts than we could potentially take on, but using margin to take advantage of these higher interest rates is going to be really, really nice. And if we had done this already, right, we're 5 months into the year. If we had done this for the other 4 months of the year, we'd have $1,600 more and our return would look a lot better. So it took us a sec to figure this out. But now that we've got it figured out, it's going to be really nice having that one mid-month week where we get distributed about $400 for our account, and then we could just go from there. But that's what this line is. But top to bottom, let's talk a little bit about what we did, right? We like to roll losing positions into the following week. Macy's was an example of that, right? I think with Macy's, 2 weeks ago, we didn't even lose. We only made $80. And then this week, we made 110. And this entire time, Macy's has been moving against us. Little spoiler alert for next week. We rolled it into next week as well. That same 15 strike. And if it stays where it is, that's $190. You add that to what, the 110 we made, that's 300. And then you add that to the $80 that we had 2 weeks ago. And all of a sudden, you've got $380 of profit on Macy's. And if we take a look at the Macy's chart here, you know, this is the move that we've had to combat, right? Ever since 1620-ish was our entry, and we're now in a position where over the last couple of weeks, we'll have made $380 on, you know, effectively leveling out. And why did we have confidence that this thing was going to level out? We go to the 1 year basis, RSI got down into the low 20s at one point, so it started to level out here around 15-ish. Another interesting point to talk about, because this is a big point of potential profit next week for us, is Shake Shack, RCL, and PHM. The first thing is we made one mistake last week. And again, we never want to evaluate our mistakes in such a way where we say, oh, we lost money on this, it was a mistake. Because we could do something smart, we could do the right thing, and we could lose money. That doesn't make it a mistake. We don't want to judge our strategy, you know, I guess we do want to judge our strategy based on results, but we don't want to like look in hindsight to say, oh, this was stupid because it lost money. No, I think it was smart that we had this. I guess there are several positions that I like where we lost money, but this is not one of them. This is the one place I think we made a mistake, and it was on Shake Shack with these 67, 69 strike covered, or not covered calls, call credit spreads. So the idea is, of course, we want Shake Shack to be below 67 by the end of the week. Now, one thing that happened with Shake Shack was last Friday, not 2 days ago, but like 9 days ago Friday, we had this position open and it dipped for us, right? If we go to the 10-day chart, this is going to be a little bit more apparent. But you'll see Friday, where is it? 512. It dipped down for us, and we had the opportunity to close these out for 50% profit. We did not do that. So what we could have done on that Friday for starters was close out for like 35 cents, take $100 of profit. I've still got these formulas working. So boom, we would have made like 140 and it would have been a much better week. We did not do that. We waited. And now that's not necessarily, I mean, that was a little bit of a mistake, but then I think part two of the mistake was not waiting further, right? We know that our strategy with some of these credit spreads is to wait until that long leg is breached, and it absolutely did get breached. It got past 69. And we closed when it got past 69 just because I wanted to be a little bit safer, to be honest. And there's nothing wrong with that. However, if we play this the way that we normally play these things and let this position play out the way that we normally like to, it would have involved uncovering, so having the short 67 strike calls, and then we finally would have got that sell-off that we were looking for on Tuesday, Wednesday, and Thursday. So it would have turned profitable. And in fact, if we just held the position, didn't manage it at all, it finished below 67, that would have been max profit, and then we're looking at like a $1,500 week. So that's like a $400-ish swing in our P&L for the week. So those are situations we look back on and say, okay, we could have definitely done better there. But at the end of the day, we made a mistake. It cost us $200. That's not the end of the world because, again, the strategy here doesn't revolve around just one position during the week. It revolves around several of these building up and combining to make profit. So we had several things where we did the right thing that worked out for us to where that mistake gets a little bit buried. RCL is an example of one where we did take that example of closing the long leg on the spread. And the example here, right, we had a 78-80 strike call. Again, that means we sold the 78 strike calls short to derive the profit from, and then we bought the 80 strike calls behind them to create the spread and limit our potential risk. Give a defined risk trade. And if we go to RCL, you'll see on the 1 year chart, very, very similar bearish type thesis, right? RSI is above 70. We're waiting for a little bit of a pullback. It did break through here, but we're hoping that since it's above 70, that it's going to come back down below 70. Or I guess for last week, we were hoping it'd be below 78. But of course, that didn't happen. As things often do in the market, it moved against us. But again, another one, you'll notice that it was down at like 75. So we had the opportunity early on to take profit. We did not do that. That was another potential mistake, I think. Locking in profit on a Friday, when you have an option that expires the following Friday, I think needs to be a little bit more of a no-brainer for us. Because a lot can happen very, very quickly with these credit spreads, as we've seen, right? You've got a position where you want it to be below 77. This thing's trading at 74.93 Monday morning, and you're like, okay, we've got, we're set. And then all of a sudden, Tuesday morning, Tuesday early afternoon, pops up above 77, and all of a sudden the next morning, it's pushing 80 a share. But we knew that 80 was a level that we'd be happy to play it back down from. That's why we had our long leg there, and then we went through the process of closing the long leg. So again, handy dandy system calculator is making its way slowly onto the screen right now. Why did we do this? And it all has to do with our break-even price on this trade, right? We know that if we saw a 78, 80 strike call credit spread, and we did this for 54, it looks like, our break-even price is 78.54. Nice and easy. 78 short leg plus the credit we receive, which is the credit of 98 minus the debit of 44 for the overall 54-cent credit on the spread. However, once we ran past 78.54 and we started pushing 80, that's when we said, okay, the second I saw 80 here, we said, we're taking the top off of this thing. And why do we do that? And the answer is, again, because of this break-even price. Remember, we start at 78. I'll just write this here, 78.54, so we remember it. And what this does now is it creates a naked call trade with these 78 strike calls. And if you're not comfortable doing this, by all means, do not do it. But this is one potential way to manage these things that we found to be pretty effective. So this now turns into a trade where we have these 78 strike calls. We sold these things for 98 cents of premium, meaning our break-even price on those alone is 78.98, which is already higher than the 78.54 that we were in. But the great part about this is we remember this long leg, we close it out for profit, right? And this is a difference of, what is this? Sorry, I'm having a bad mental math moment here. 89 minus 0.44, 45 cents. So that's a 45-cent profit right here. So we now, again, have these 78 strike calls, which we sold for 98, and then we took 45 cents of profit on. So all of a sudden, we have a trade that we went from having a 78.54 break-even price up to a 79.43 break-even price, right? Went from 78.54 up to 79.54, and all with just one quick move of taking the top off of the trade right there. So we kind of rode that one out. And then on Friday, unfortunately, we got to the point where it, in the morning it was pushing 80 and ran back up to 80. So we kind of had to close those and roll them into the following week. or not 80, but we had the 78 strike calls. You know, it looked like it was potentially going to come back up. It was pushing 80. So we closed the 78 strike calls out for a little over $2. Our hand was forced a little bit on that one, but all in all, we had a trade where since this thing finished at what, 79.5, our initial 54-cent credit or whatever we said that was would have been worth a buck 50, meaning we would have lost $300 on the trade. But thanks to doing this, we lost $180 on the trade. So we save a little bit of cash right there. And the great part about this is we could just roll those calls into the next week. The same way that we like to roll cash secured puts down and out for a credit, we can roll these short calls up and out for a credit. So we rolled them up a strike to 79 strike and we got a credit, right? We closed out for 203 up here and then we sold the new ones for 227. So what that does is this break even price that we had right here, the 79.43, by rolling up a strike, boom, it's now 80.43, and rolling for a 23-ish cent credit means that our new break-even price going into next week on this thing is 80.66, which is all the way up here. So we went to 80.66 after starting a trade with the break-even price effectively down here, all through taking the top off, rolling these things week over week. And it's very, very flexible, right? So now we go into the following week, and if this goes back down to 78, we've actually got some really decent upside on the position, right? These will expire worthless. And even though we lost 180, whatever we said it was last week, if this goes back down to 78, we're making $681 in 1 week off of RCL. And again, if this goes back up to 79.5 even, and this is worth 0.5, we're still pulling significant amount of profit. Of course, the risk on this comes if, what if RCL goes crazy and goes to 85 and these are worth 6? We're going to have a sizable loss on those. So we want to take it easy. The one thing when we have naked calls like this is it's very, very important to have that idea of a mental stop loss. It's tough to have any sort of literal stop loss on options due to the way that the bid-ask spread works and the way liquidity works. However, if we get to a point on these naked calls where we've lost $1,000, we're going to get out of the trade. The upside to this is that we can, roll it out a week, roll it out a week, roll it out a week, and kind of roll with the punches here. Whoops, not 10. And then have some decent upside waiting for us on the other side. But, of course, it comes with that risk of the potential loss. But look, we kind of put our money where our mouth is with RSI. As this thing continues to push upwards, we continue to scale in, raise that break-even price up, 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 and then get to a point where we're effectively shorting it for when it pops back down. And again, we've seen RSI at these levels before. Very, very similar look right here where you get that little bit of relief, and then that's kind of what we're trying to bank on here. So hanging tight with that one. That's the situation there. Let me get this formula back to where it needs to be. There we go. And that was RCL. So again, between those two, we lost $380. One of them was, they both were mistakes in the sense that we didn't take very, very early profit. The Shake Shack was a further mistake in the sense that we closed it out early and didn't manage it the way we did RCL. If we managed it the way we did RCL, Shake Shack actually would have turned into a very, very nice profit for us. Probably something in the neighborhood of $700 or $800. So that could have been big time, but we just got to kind of trust the process a little bit better. We'll keep working on that. And then the last one we want to talk about with those credit spreads, PHM, another one with a very, very similar setup, right? You go PHM, you're going to see RSI 72.97. Yeah, and Eudaimonia, welcome back to the Twitch chat. It's finally showing up on the screen today. I love it. But yeah, that was the biggest thing with Shake Shack was that headline came out that an activist investor was getting involved, and I'm okay to continue these RSI related trades so long as the fact pattern remains consistent. However, when something like that happens, the fact pattern isn't necessarily consistent anymore, right? There's been a little bit of a change. So that's kind of why we wanted to step off and say, hey, this trade could get a lot messier than it currently is. We just called a $200 loss. We keep the thing moving. That was the idea there. And I don't think it was a bad idea. It just is a little bit rougher in hindsight when we had one opportunity up front to take profit, and then we had another opportunity to play it the way that we normally play these spreads, which would have worked. So that's where a little bit of frustration with that position comes from. But hey, that's what happens, right? There's going to be mistakes made every single week. We just try to clean it up and keep the ball rolling. And that brings us to the third credit spread, which is PHM Pulte Group. Very similar setup. RSI was above 80 on this one. So anytime it's above 70, we know it's very overbought. We like to go in. Anytime it's above 80, something definitely has our attention. And the great part about this 1 year chart is you don't see any massive spikes, right? There's a big jump up and a big gap up here from earnings. But they didn't really have earnings, so the grind upwards, so to speak, here is probably the closest thing we were going to have to any sort of further upside risk. So we started playing it down with the 68-70 spread. And of course, it got up to 70. It breached. So what did we do? We took the long leg off because the idea is that once the stock gets to 70, we have this long option. If you have a long option or any option at all that is dead at the money, it is basically purely extrinsic value. So unless you continue to get a move in that direction, it's going to lose value very, very quickly, especially later in the week. So what we did was, again, we had this spread that we sold for 45 cents off the bat. Where's this? Here we go. It was a 68.5 short leg plus 0.4-ish, right? So we had a 68.9, 68.95 break-even price. By taking the profit on the 70 strike call, this now turns into a 68.5 strike call, naked call, where we have 68.5 when we sold it right here for 71 cents. So all of a sudden, we're already at this higher break-even of 69.21, and then we took profit of 16 cents on that long call. So all of a sudden, our break-even price jumps up to 69.37, and of course, that's not quite 70, but when RSI is already high and it moves even higher, that gives us further vindication and confidence that's going to come back down. So we're happy to kind of scale up, and maybe even though the potential trade that we made puts our break-even below the stock price, that's just what happens sometimes when it moves big time against you. And on Friday, we got a nice little release here on the stock prices, moved back down below 70 and actually down to 69-ish by the end of the day. So what did we do? All in all, those 68.5 strike calls that we sold, we got out of them for 0.9. Those were a $57 loss. We took $48 of profit on those. And what we actually did was we scaled a little bit further in, actually, by adding just one contract, which made us 46 bucks. And with RCL, we rolled into the following week and we had a $180 loss. With PHM, we rolled into the following week. However, we actually made money on this trade. So you look at this thing on a 5-day basis, pretty clearly. This is a 10-day basis. Let me go to the 5-day. Pretty clearly moving up against us overall, right? It finished higher than it started. And despite the fact that we had a bearish trade on that, we made money. And now roll into the next week where we've got these 69 strike calls, again, kind of dead at the money. So if this thing stays flat or falls back down, we're in position to make over 300 bucks back on it. And not even making that money back, but it's 300 bucks in addition to like that 60 or 70 that we saw that we made already in the prior week. So that's where these first couple positions for next week come from. The RCL and the PHM, they're short calls. That's definitely where our risk is going to be focused for the upcoming week. We'll keep an eye on those. But again, if any of them get up to like an $1,000-ish loss, we get out, we accept that we're wrong, and we keep the line moving. But again, on the flip side, if we're right and we get the moves that we want and these both finish worthless, we're going to take home a profit of about $1,000 between those two, and it's going to look very, very nice. And again, these are bearish positions. So you might say, HT, if the market goes down, what's going to happen? I can tell you what's going to happen with these two if they follow suit, is that we're going to make at least $1,000 from those, and we've got 1, 2, 3, 4 more bearish positions on there that'll stand to benefit as well. So I think we're well positioned for a red week, which kind of leads me into my other point for the upcoming week. Why are we positioned for a red week? We talk about RSI with Pulte, we talk about it with RCL. Well, let's take a look at it for the S&P 500. And if we pop this thing back to a 1-year view, we are getting a little bit overbought here. Now, it very, very rarely gets up here to 70, to above 70 on a 1-year basis. It's really only happened last August. And when that happened last August, we went from 431 to 348 in a very, very short time frame right there. So that's something to pay attention to. But further, not just the S&P 500, we take a look at QQQ, which is effectively the NASDAQ. This is at 71.34. You know how many different times this thing has been above 70 in the last calendar year? The answer, similarly to the S&P 500, is 1. And that happened at the beginning of February. And what happened at the beginning of February when it got this high? It fell back down for the next week or so and continued down for the next month and a half. And again, we don't need to nail the tops of these. We could start bearish and then scale in, kick it week after week after week. But the idea here is we're bound to get some sort of a breather, right? And it was slightly red on Friday, so we got a little bit of one, but it's still elevated above 70. So we're going to hang tight there. And then specifically with QQQ, right? We don't necessarily want to play QQQ down, but we could find something with very, very good premium like SQQQQ. QQQ. I think I added 4 Qs there. I'm out of control. But now with QQQ overbought, SQQQ, the inverse ETF for QQQ, a lot of Qs going still, is now oversold, and it's a great opportunity for us to scale in here. So what did we do? Last week we sold a 26 strike put for 50 cents. And we had one good question in the Discord of saying, hey, SQQQ, and if I pull the chart up here on a 5-day basis, it's going to make a lot more sense. I think we did this on, I forgot if it was Thursday or if it was Friday. Either way, it was a very short trade, and we did it when it was right around this price level, 25.67. So what you'll notice is that this 26 strike put that we sold was actually in the money. And you might say, hey, why are we selling puts that are in the money? And the answer is because, one, it's a half-size position, so it's very easy to manage. And two, I think if it was a Thursday or a Friday, it's a very, very short time frame and easy to flip over. And third, if we do get that move we went directionally, SQQQ is going to finish above 26, and we are going to take home a profit of what, $200 right there, and that was going to look very nice. Now that didn't happen. However, what did happen was we were able to roll it very effectively. So what happens, right? We have this 26 strike put that we sold for 0.5. We know that we had a 25.5 break-even price on it. We go to the chart, 25.5, good place to be. That's about where it finished. However, we go into the following week and say, hey, let's actually keep this upside at 26 and just roll it again. And closing for 54, opening for 97, that is a 43-cent credit. So since it's a 43-cent credit, our break-even price goes from 25.5 down to 25.07. So all of a sudden, we now have this 25.07 break-even price on SQQQ. And can it go lower than this? Absolutely. But further, our defense mechanism, if that does happen, is that we've only sold 4 of these. That's a half-size position. So if it does go below what we just calculated, if it goes below 25.07 and we're now losing money on SQQQ, we're in a position where we could double down and get even lower than that. And then if it goes lower than that, with QQQ already overbought, it's objectively going to be a good place to go bearish at for us, especially on these week-to-week trades. So I'm perfectly happy with how that one's shaping up. But small loss there. And again, what we've done better this time, and I think we haven't done the greatest job in the past of, is we've nailed some of these moves. Like we've been dead on with them, but we sell out of the money to be careful just in case we're wrong. And that caution helps out a lot with stuff like RCL. It helped out with PHM because we were wrong off the bat on those, and then giving ourselves a little cushion and scaling in, turn those potentially profitable for us. So that's why we do that. But with stuff on these indices like SQQQ, I think you can get a little bit more aggressive. And by aggressive, I mean selling something in the money. So it's not just, oh, if it falls down, we've got a cushion because our strike is out of the money. No, it's if this goes back up, not only do we get the $212 from it decaying at the current price, but I want additional upside. So if it goes back up to 26, I don't just want $212 of profit. I want 388 so we get some benefit to the upside. Because when we nail these moves, we need to set ourselves up for a little bit more upside than we've previously had. And again, that sounds risky to say, but at the end of the day, remember, we still do get that cushion. We still do that. We still got the cushion, right? 25.07. We're still protected down to 25.07. We're just playing the move back up to 26. And if we get that, we've got a little bit more reward waiting for us. And again, anywhere between 25.07 and 26 is some level of profit in between. And we can do the exact same thing for the following week and just roll that 26 strike put out again, get the break-even price down below 25, and just keep the line moving. So that's the idea there. And then not too much else to talk about. Penn was one that we really effectively scaled into. Sometimes it can be a little bit scary to scale into some of these trades because you're losing. And Penn 2 weeks ago was a decent-sized loser for us, right? We lost 261 and then 24 on the double down, so we lost 285 on it 2 weeks ago. But by scaling in, increasing our position size as something falls down, you're not necessarily, in a sense, you're kind of trying to catch a knife, but we've got cushions where it's almost like you're catching a knife with gloves on or some sort of armor on your hands because we can just keep moving the break-even price further and further down. We don't need to nail the bottom necessarily. So what we rolled into made us 159, 111, and again, it only made us $9 on the shares, and then we made 114 on the covered calls. So we're up $108 on Penn overall, despite the fact that when we entered into this thing, it was trading above 26. We look at the short-term chart, we got a very, very nice bounce that allowed us to scale into it, but on a 10-day basis, we kind of got into this thing up at this level. It's trading down at this level, and we're still making money on it. Welcome the Drummerette. Welcome to the Twitch chat. Question, why do we use Google Sheets over Excel? Great question. I could probably go on a rant about Google Sheets because I work in finance. I'm a big Excel guy. Love Excel. Miss all the keyboard shortcuts. I can't use those on Google Finance. But the reason I use Google Sheets is simply because of all the people who follow and want to watch along. This is and have things, use the Google Finance formulas to pull stock prices in, get a shareable link. It's just a lot easier and more intuitive to share with others. If I were doing this on my own and I didn't care about anyone else looking at it, period, it absolutely would be in Excel. I much prefer Excel to Google Sheets. What were we talking about? We're talking about Penn. And again, we've got this break even tab here, or the breakout tab rather. We started at 26.30, the thing's at 24.53, right? So that means Penn has decreased 6.73% over the 2 weeks that we've been in on this trade. Yet at this current price, despite the 6.7% drop over a short time frame, we're on track for $240 of profit right there. That is why we do what we do. And we're back down to our half-size position, right? We're only holding 300 shares. And we could see how effective scaling in was, right? Because we added 24 strike puts, 24.5 strike puts. We scaled into a 150% size with these 23.5 strike puts. And between those two, instances of averaging in, we made $270. And you know how much we're at right now? 240, meaning the only reason we're projected to be profitable in this trade was thanks to the strategy we've run, thanks to the process we followed, and thanks to these two positions right here where we scaled in just last week. So that stuff can make all the difference in the world. And when you scale in, your first goal should be to find an opportunity to scale back out. We start with the half size, we scale into full size, and as you can see here, sometimes we go over full size. Like this one, we went 150%. I'm okay with riding out a 100% size position for a few weeks. I'd always rather be in a half size position, but very, very specifically, when you go over 100%, your first goal should be, how do I get out of here? And that's why we closed this one early for 7 cents, just to get out, get the capital back, because you never know what's going to happen. But back to the weekly tracker, MOS, another good example. That thing had kind of been burning us a little bit. We go to the MOS chart. It's going to look very, very similar to Penn, to be honest with you. It's just been dying on us. But we go to the 1 year chart. This thing's oversold. That's why we're getting in on it. And a really nice valuation, right? We took a look at the Analyze tab last week. You go MOS. And you're going to see a very, very nice PE ratio. Now, it is a materials company, but you've got a 4.4 PE ratio. When over the last 5 years, they've averaged 10.86. So from a valuation perspective, perfectly happy to start scaling into this level. And again, you'll notice we started with 3 contracts. We got up to 6. Next week, what are we doing? We're right back down to 3. We've got that flexibility back, and we are good to go. But again, point being, 2 weeks ago, MOS moved against us. How much did we lose? We lost $231. Last week, we scaled, we rolled. What did we do? We made back 132, we made back 171, and all of a sudden, despite the fact that the chart on MOS looks like this for our bullish position, we are now in a position where after last week we've made $72. We're in a half-size position where we're trying to get 216 more back, and then all of a sudden we could be making $300 plus just if this thing goes back up to 36, which is around where it started. So we're generating money on just no movement at all, start to finish there. And that's pretty much the rest of what I wanted to talk about for what we did last week. We had an XSP strangle, which moved against us, which was a little bit annoying. Those have kind of been doing poorly for us lately. Probably not the best idea to continue selling those in a lower volatility environment. So we'll probably hang tight and wait for volatility to pop up. From an economic calendar perspective, we've got FOMC minutes, 2 p.m. Eastern on Wednesday. And because of that, that's a potentially volatile event. I just like to sit those out. From a strangle perspective, because if the Fed decides to say anything crazy, then something crazy is going to happen in the market. Something crazy happening in the market does not bode well for those strangles. So, point being, we don't have one for next week. But that was last week. We made $1,000. We underperformed slightly, but again, we followed the strategy. We've been doing this for almost 3 full years now, and we are crushing the S&P 500 and NASDAQ. So, I'm happy to underperform if it's a green week in the market and we're also making money. Because again, the trade-off here is that when the market turns around, like we saw in February and March right here, when the market turns around, we're still going to either be flat or continue to push upwards, right? We're not necessarily dependent on the market going up to make money. Like, for example, we've got $1,000+ of profit lined up for next week just off of the first 2 bearish positions you see on that list. So that's what we've got. And let's talk a little bit further about the rest of the roster, right? We talked about last week. That's great. It was our 10th winning week in a row. How are we going to try to get to week number 11? And the answer, we've already talked a little bit about it, right? We've got the RCL, the PHM positions that we've kicked into the following week. And again, these are also opportunities where if we do get that move in our favor on Monday, on Tuesday, we could either close out or at the very least just cut the position down to take a little bit of risk off the table. I've always found that there's a very, very nice compromise out there because you will so often find yourself in situations in the market where you're like, okay, I think this is an acceptable amount of profit, but I also kind of want to ride the position out. I don't really know which side to go for. And more often than not, I found a fantastic compromise just to close half of the position. So one half of your head gets its way and the other half gets its way as well. And again, if it worked out and it's like, oh, it would have worked, boom, you get a little bit of extra money. And if it didn't work and it moves against you, you say, oh, well, it's a good thing I at least closed out some of it. So that's the solution I have for anytime I'm in that situation. But again, we talked about SQQQ. In the money, 26 strike put. We're down to a 25.07 break even price on that one. And we're just going to continue to ride that one out. Macy's, we're back in on that 15 strike again. I like the 15 level on Macy's. I think there are some retailers which have earnings this coming week. Macy's is not this week, but they're next week. So we don't have earnings risk on that one quite yet. But there was a decent amount of premium that we were able to get, right? We go to this Macy's chart. Really, really big sell-off on Friday, to be honest with you. Kind of surprising. And I remember having a chat in the Discord saying, oh, you don't need to worry about 15. It'd be pretty hard for it to come back down. But there you go. Lesson in the market. There is no strike theoretically that is out of reach for a stock. But we go back to the 1 year chart. It's basing around this 1450, 15-ish level. RSI's at 37, implied volatility coming up a bit. Still a decent company to continue to sell options on. So I'm gonna keep doing that. And if we get a move in our favor, this thing goes back up to 15. Boom, we've got $295 of profit to show for it. If it moves against us, we we have a pretty big cushion. We've got a cushion down to 1441, 2.57% cushion. Let's hear about this. We've got another comment from Rhett. Curious about experience in finance. I'm working at a private markets fund currently while in undergrad. I'm considering doing sales and trading post-grad or a global macro hedge fund. Do I have any experience in pricing derivatives and any of the textbooks the sell side teaches? I got you. Would love to hear about the training and background. So I don't have hedge fund. I don't have sales and trading experience. I work in M&A. So I'm on kind of the private equity advisory side. I run diligence on companies that are, being considered to be purchased. And then we kind of work on the private equity firm to figure out what the target is worth and what the purchase price is. So that's kind of my experience in finance. So unfortunately, I don't know too much about the S&T side. I don't know about the macro hedge fund side of things. So I'm not going to sit here and talk out of my ass to you, but if it were something up my alley, more than happy to talk about it. Or if you have any other general questions about, banking or private equity, probably am better suited to answer those than those two questions. But that's the extent of my experience. I've got a decent M&A experience, and then I'm putting a video out, and we do it sometimes on the stream where we go look through financials. It's very interesting sometimes to go cut through and look at the different lines of the income statement, look at the balance sheet, and kind of deduce what the financial position of a company is, because that's kind of right up the alley of what I do, and a very good way to get comfortable with some of the companies that you might be selling options and potentially taking assignment from. But moving further down the list, MOS, we talked about that one. These things, when they get oversold, we're just going to keep rolling with them until we get that jump up that we want. And sometimes you're going to sell an MOS 36 strike put. It's going to go to 40. You're going to be like, oh, why didn't we just buy the option? Oh, darn. Because sometimes it's going to move against us, and we're going to be happy that we sold the option. So Peloton, another one where it's pretty low right there. Let me go to Peloton. 36.49. It's already bounced off 662, finished at 717 last Friday. Again, it's not like we expect Peloton to run back up, or we need like a short squeeze, or we need some sort of coordinated effort or anything. That's the great part about what we do. All we need is just price stability. And Peloton is one where they have a decent user base. There may be some issues about growth. I know there was a headline about recalls, which really I think was oversold. Hey, Petty Bourgeois, what's going on? Welcome to the stream. But I think that Peloton headline on the recalls was pretty overblown. And if Peloton continues to get crushed like this, I think they're a very, very good potential acquisition target. We got a question from Focus Pick in the YouTube chat. What are thoughts on Disney for the upcoming week? Well, let's take a look at Disney. I know they just reported earnings. I know it didn't go very well. Their streaming services were not the greatest. Let's look at it from a technical perspective, and then let's look at the options. Let's figure out what we think a potential move right here might look like. So implied volatility basically at a 1 year low. From an options selling perspective, this is probably the least amount of premium objectively that you're going to be able to get on Disney over the last calendar year, but that doesn't necessarily mean it's a bad idea, right? Because you've got 40% down to 30%. It's not as volatile as some of the other drop offs that we've seen. But we're past earnings. We're at a very, very interesting point in the chart here. And in fact, I have this red line drawn from a while ago. And this is why we like to keep the lines drawn because they stay relevant, right? After the big drop that we saw, a couple weeks ago off earnings, it went down to this red line and started to stabilize there. So was 90 a good spot for the stock? And from a technical perspective, it looks great, right? Because it bounces off here back in July of 2022, bounces very, very sharply off there in October of 2022, breaks through there, spent, maybe 2, 3 weeks below that level and then came back up. And when it hit it again, back in mid-March, bounced right off it again. But again, we are back at the line. So really when I try to set up an option selling trade, we get this cushion. So I want to be, one, comfortable with the current price and play it as if it was something I was just playing long. And two, I need to have part B. And the issue with Disney right now is, what can be? And the answer to it's tough to say because we have this gap here. And this gap isn't like a gap from 90 down to 88. And it's like, oh, we're good to go. The gap here looks like it's 90 down to like 85-ish, which is what I've got pegged. You say you're looking at the 90 strike short puts. At the end of the day, this is one of those things where Disney is a blue chip stock. They have revenue. They're going to be okay. So at the end of the day, you can't go too wrong, especially on a 1 year basis when you're looking at a stock price on the lower end of things. However, let's take a look at the option shanks. We've done all this talking. We still haven't actually looked at the options themselves. And you could get a 1% ROR at 91. You can get 0.72 at 90. We know that we like to talk about targeting a 1% ROR per week on our positions because that's going to give us that annualized potential return in theory of like 68%. Now, that's not us saying that we're going to get 1% every week because that'd be fantastic if we did. We'd be crushing it. But that's just what we like to target. And often you fall a little bit short of the target, but when you fall short slightly of a good target, you still end up with a good result. But I don't hate the 91s. I foresee a little less volatility in the market here. You're catching this thing at a 38.38 RSI, but there are instances over the last calendar year where this thing does get down to the 30s, right? I'd maybe wait on a break here, especially if you're not like in love with potentially investing in this thing. If it's a short-term swing, that's one where I think a credit spread would be a very, very good idea. Because we say, hey, we're potentially worried. We like the 90 level. I think we agree that we like the 90 level. I don't think there's an issue with selling 90, 91 strike puts. But the issue that we have identified, and I think we might agree on, is that below that, it's kind of no man's land a little bit. There's not a lot of precedent. And I really like looking to the left on charts over the last year, last 3 years, whatever it is, and seeing a little bit of precedent at a certain level. So I can be comfortable, having a stock in and around a certain area. So a credit spread, I think, is a great way to kind of bridge the gap of saying, okay, I want to sell a 90 strike call, but I'm also a little bit worried about what's below. Because what that does is, of course, you benefit. If you sell like an 88.90 put spread, and we could just kind of quickly do this here, an 88 long leg, 90 short leg, and we wanted to sell like 5 of these things, what we get is a position where we have, a similar max gain of 185 and max loss is 815. Which is still a decent amount of money, but at the same time, it's a lot less money than you would lose if you sold a few of these things and it really, really moved against you. Now, like, what do you sacrifice, right? So if you wanted to sell a 90 strike put, you get, or let's do 91 for the sake of the example. If you wanted to sell a 91 strike put, you're getting 97, 98, 99 cents a premium. If you wanted to buy one behind it, you're sacrificing, about half of that return in exchange for a little bit more comfort. Whether or not that's worth it right now in this environment, I think it is worth it because, we think about bullish trades, not even just at a micro level with this individual company, but at a more macro level looking at the S&P 500. It's 60.72. We look at QQQ. Now, Disney's not part of NASDAQ, but it's 71.34, which tells me the market's going to come back. And these are situations where, one, when things are getting overbought, and two, we look at VIX, volatility is low. Take advantage of that low volatility by entering into spreads because in theory, that long leg that you buy behind it to protect the trade is going to be a little bit cheaper. Now, the short leg you sell will also be cheaper, but, it gives you protection, which I think is, conserving capital. We talked about this at the top of the stream. All of this stuff is so important. I'd rather make a little bit less knowing that there's less risk of further downside than have that, greater initial return with the risk that there is further downside, right? Because what we talk about, that the little dips are so detrimental. The strategy that we're trying to run is just good, consistent profit week over week over week. We're 10 in a row. We're going for 11 in a row. And if we could just accomplish taking that big red week out of play, right? For example, this 37 one, if we take that out of play, our returns already look way better. But again, we've had, 3 losing weeks this entire year. And that's kind of the idea we follow. Just fiercely conserve that capital. So those are my opinions there on Disney. But to kind of round out what we've got for the coming week, SPXU, this is a bearish ETF for the S&P 500. We've been playing this thing as a little bit of a hedge, and with the market going up last week, we made money, but with the market going up, we lost a little bit of cash on that hedge. Now, we only lost about $265 on it, so, no big sweat, and we're selling 13 strike calls for the coming week, meaning we're getting at least $105 from that call premium. And then if these things shoot back up to 13 and we get them called away, that's going to be 220? Yeah, 220 a profit. Sorry, getting late. But that's 220 a profit there from that hedge if the market does go down. And then Penn, this is a great example, right? We talked about scaling in, and I'm probably going to repeat myself a little bit from when we talked about this one earlier, but we talked about scaling in and how effective it is to go from 300 shares, to a 600, 900 size position, right? Getting into a full size position, getting up to a 150 size position. But when we size in and it goes our way, we want to get back out. Get back out to that very flexible, that very manageable half size position. And again, another similar idea where your returns might be a little bit smaller off the bat, but if things move against us like they did with Penn when we have that trade breakout right here, even though we're in a situation where we lost $441 on the shares that we've been assigned from that initial position, we're still making money. And if you could make money on a trade that drops 6%, 7% against you in 2 weeks, you're going to do very, very well in the long run. So we're back down to the half size position. RRC is a position where, last week we talked about one of our mistakes was not taking early profit on RCL, not taking early profit on Shake Shack. We had a very similar setup with RRC. So on Friday, and to answer Jeff's question in the YouTube chat, we do open our trades for the following week on Fridays. And I found that there's a decent amount of burn over the weekends. In theory, it is priced in, but I feel like in practice, we get a lot of, decreases in option premium over the weekends, and Mondays are normally pretty good for us. What was I talking about? I was talking about RRC. So very similar situation where we had our scanner set up. We had something that says, hey, this thing is overbought. This thing has decent premium. So what do? We go in and we play it bearishly. And if you look at the 5-day chart, we got in Friday right around here, and we nailed the timing on this one. This is fantastic. So we nailed the timing and said, hey, we got the move we wanted. I'm not going to get greedy because Monday, Tuesday, Wednesday, Thursday, and Friday are ahead of me. That is an eternity in the market. That is so much time for something to go against you. And the only guaranteed thing in the market is the prices you see in front of you. So what we did was we took 50% of the profit. And again, this wasn't some insane trade where we were, going crazy and taking home $200. But hey, 60 is decent, because what if something bad happened and this goes up to 80? All of a sudden you go from a 60 profit to a 200 loss. And all of a sudden that 60 profit doesn't look as small as that $260 swing that you just had in your P&L. So boom, you get in, you nail it, you get out, don't get greedy. SMCI, another bearish trade that we have, which is a very, very similar idea, right? Came up in the exact same scan. SMCI, we did get a little bit of a move in our direction as it faded off towards the end of the day, but you go to the 1-year chart, 79.48. And this is a very, very similar RSI reading to PHM, 79. It got to like low 80s here before we saw one of those initial red candles. So SMCI, I'm happy with it. I'm happy to play it back down. But the reason I'm not going naked here is because there's some very, very big green candles. So what do, we set up the credit spread. We set a defined risk trade, and we maybe play it a little bit more aggressively, but we know that even when we get aggressive with this strategy, it's still conservative in the sense that we get a little bit of a cushion, right? Our break-even price here is 170. That's short leg plus 1.35. So 171.35. And where is 171.35 on this chart? It is right here. So anywhere below this level, next week we're making money. And the idea is this thing falls back down to low 160s, maybe high 150s. And then we could pop out for like 35 cents. Boom, there's $100. Don't spend it all in one place. But But that's what we got there. And then the final trade to round us out for next week, and then I'll address your question about PayPal puts. I think that's a good question. And then we've got BTU, which is a very similar idea, but it's the opposite direction, right? It's a bullish trade on BTU, which is, I forgot what it stands for, Peabody Energy. We go to the 1 year chart, right? Decently tight range, you know? I mean, you might say, oh, what do you mean tight range? It's gone from 19 to 32 and then back down. It gets much wilder than that for some of these things we normally sell options on. So I think a decent potential entry on a maybe more stable stock. But again, we start maybe a little bit more aggressively so we could benefit from some upside. But this thing is a RSI of, you'll see it right here when I move my mouse, 27.67. That is very, very low. We draw the line here at 20. We extend this thing to the left. And we see a level where there's been some bounces on it before. So I'm comfortable getting in at the very least with a half size position around here. And we've put it aggressively enough where we got 49 cents a premium. Max profit's going to take home 196 bucks. We've sized it such where if it does go back down below 20.01, which is our break-even price for the coming week, we could double down. We could have our break-even price at like 1950, 1960, 1970-ish with the full size position, which we kick into the following week and just, you know, keep the line moving. But that's what we've got. This is how we evaluate it. And if these stocks don't move up or down a single cent and finish Friday afternoon exactly where they are right now, we're going to make $2,078, which is what we call our base profit. And again, we like to target 1% per week. So we set the base profit right around that level. If we fall a little bit short of it, as we typically do, no worries. But the great part about this week is not only is 2,000 our base profit, but we've also set up positions which give ourselves a little bit of upside on top of that, right? Let's say we get a bearish week and we hit max profit on RCL, PHM, SQQQ, SPXU goes up to 13. All of a sudden, we're looking at $2,600, $600 more right there. And then that leaves MOS, Peloton, Penn, and BTU as bullish positions, which are all half-sized and relatively smaller. So we're not going to feel that big of a drawdown from those bullish trades. And I think that's where the balance in our portfolio comes. Right now, this upcoming week, we will absolutely benefit from a red week, deep breath. We will absolutely benefit from a red week in the market. Nailed it. But again, we position ourselves based off of our guiding light, right? RSI. We go to SPY, 60.72, QQQ, 71.34. So it's not like, oh, we scaled into bearish positions just because we're bearish positions. No, we are in bearish positions because we use RSI to dictate where we are. And as the market continues to push up, we scale into those. And as we scale into those, we get into situations like we see right here, where we generate a little bit greater profit from RCL, where we generate a little greater profit from PHM. So that's what we've got set up. And that is our week right there. So I love the game plan. There's definitely going to be some moves during the week. You'll see every week we've got this new tag right here where it's either us scaling into positions, taking advantage of what the market gives us. But there's been a lot of decent opportunity, and you'll notice that a lot of these new trades normally go pretty well. I think you'd be pretty hard-pressed to find a week where these new trades end up in an overall loss, which just goes to speak to the effectiveness of some of these shorter expiry trades. Like if we see a red Wednesday, we see a red Thursday, those are such great opportunities for bullish entries in the market. But then final question I'll address before we sign off for the night. 57 strike PayPal puts. And with PayPal, I'm actually in some July 60 strike puts. Yikes. But it's at 69 too. So I'm hoping it holds the line at 60. I liked the line at 60. That's why I sold them at 60. We go to the 3-year chart. There's like no precedent for it at 60. Their growth is slowed down, but at the end of the day, it's PayPal. They're making money. It's doing okay. And you said 57 strike puts for the coming week. I mean, those are definitely a little bit low. The 0.26 ROR is very, very low to me. I'd definitely go a little bit more aggressively with this 0.67 or the 1.11 level there. But again, I don't hate the 60 level from a technical perspective. This thing's as beat up as it gets. On a 1-year basis, RSI is at 30.74. That doesn't happen very often. You'll notice that the last time that did happen was December of last year, and it made it almost a very similar pattern, right? Where it almost ramps down, stutters out for a little bit, and then comes back up. We have the ramp down. It's starting to base a little bit. And then if it comes back up, we're going to be looking pretty good on that one. But I don't hate the entry here on PayPal at all. Then question from Joseph Anthony in the YouTube chat: have we ever gotten free shares, quote unquote, from premium collected on options? And assuming free shares, what you mean by that is, we have 100 shares and then we sell options and then we use the option premium just to buy more shares instead of stacking it and moving it. In theory, I don't really actually ever do that. We absolutely make enough to have done it. But I kind of move from trade to trade. I don't like ever having shares that are uncovered. So, for example, if you owned 100 shares and then sold enough premium to buy like five more shares, it shifts your trade a little bit to being a little bit more bullish. And I always like having every single share that I own covered instead of trying to play things a little bit more directionally. But that's absolutely something you can do. It's not something I would do. We just had the discussion about how the market's overbought, and that's not necessarily a great time for it. But if things are getting oversold and we start seeing a little bit of blood in the streets and the markets, that's absolutely a decent idea. To kind of weight your deltas a little bit more bullishly so that when we do get a bounce, because let's be honest, the next dip is always around the corner and the next bounce is always around the corner as well. The market's not going to be red or green for the rest of time, decidedly. So I think that's always a decent idea to take a look at, but just not right now with the way current market conditions are. But there we go. We hit the hour mark. Back to the full screen webcam. And that's all we got for this week. So again, to all the new viewers, welcome. We got to 18 viewers at the peak. So unfortunately, we did not get to give away the HT Yeti tumbler. So next week, we will be back. We will be trying to get 30 viewers. I don't know if we're going to do it, but we will eventually. And someone is going to get this tumbler. I swear it's going to happen. I will send it out. And then we'll raise the viewer goal. But again, thanks so much to you, those of you who tune in week after week. We are going to be in the Discord server if you want to talk to us during the week, is like the point we made at the end of the stream. We can only plan so much when we talk about these things on the weekends. And normally we do a pretty good job, right? A lot of the core positions that we hold each week drive us to a nice monthly or weekly, rather, profit. And then we build on that from there. So it's great, but a lot happens during the week that we could take advantage of. And of course, we talk about that in our Discord server. You could visit us and join that for free on our website, hourglass-trader.com. And then there's also the option for HT Premium, where you get all of our trades alerted as we make them. A little self-promo here at the end of it. But you also get links to our option scanners, where we find a lot of these setups that we talk about tonight. But that is all we've got. So until next time, this has been the Hourglass Trader, where as time passes, we make money. Thanks for joining us for another week, and hopefully we talk again same time next week with more money in our account than we have right now. See you guys later.